Hello, welcome everyone. So the question begs, is it DEFCON 4 mode or is it safe to return into long equities for a seasonal Santa Claus rally? Or has the Grinch stole Christmas, so to speak? Let's take a look at a couple different models that I use. First, this is based on the J-Person, the Algo Optimizer strategy. We have at the very top, we have a SPY, and then at the bottom, we have the leveraged SSO. What I like to see is conforming signals. In other words, if it's going to generate a buy here, it should generate a buy at the same level. If you'll notice here, it may be hard to see, but the SSO generated a buy a couple bars before the spiders generated a bar. So if one's going to generate a buy signal and subsequent, if it is a strong signal, then the underlying leveraged ETF may, or the corresponding market may generate the same type of signal. So even though they are two of the same product, more or less, one's the leveraged ETF SSO and one is the SPY. So with that stated, let's take a gander. We are the models are short SPY right now. Here's your short position right now. And we're also in a model short position in SSO. So is it safe to return from the long side? Well, you'll notice what's ironic is that we have just to define what this color means. This was the stop entry when the trade was first initiated. This was the initial profit target, but this doesn't get out of the profit. This gets out on a trailing stop function. And then as you can see, this red arrow line in the sand, that's a new stop. A trailing stop function kicks in. And if you notice here, a new stop function has kicked in. And they're both very similar in their location. And what is that location? Today is, of course, December 18th, and it's the first hour high. So what would happen if we're going to initiate a new long? First off, let's get the shorts covered, right? So until system traders see it's time to cover shorts, why would they ever go long? So that's one thing that's we have to wait for. When the systems cover shorts, then we'll start looking for buy signals. We don't have that right now. How much lower can the market go? Markets can go wherever they want to go, but we use other forms of technical analysis to help us kind of navigate these. One is advanced decline, and two would be McClellan oscillator. Now, let's take a look at the McClellan oscillator here as far as the S&Ps are concerned. Yesterday, we got slightly overstretched. I mean, a negative 200 reading, and it was a little bit more than that on an intraday basis, but this is a setup pattern, gang, not a call to action. It's a warning sign that if we actually do recover, and I'm going to mark X marks the spot, notice that the current X's in price and the corresponding X's on the McClellan oscillator. We are, in fact, forming a potential bullish convergence. And the last time we had that kind of bullish convergence existed at the beginning of the year. Remember, we were it was a scary situation there as well. So we did have a bullish convergence scenario develop there. But what did we wait for? Well, let's discuss that. It's this area in here that formed the corresponding McClellan oscillator convergence. What was the condition on the advanced decline analysis? Well, the advanced decline analysis was also confirming a higher low. And we don't have that right now. So that's one component that is sort of missing from this setup. This picture does not look like this picture in accordance to this advanced decline analysis. And I think that's why a lot of traders, you may have seen a lot of investment strategists and as well as analysts in the last day or so say, hey, the advanced decline or the breadth of the market's weakened and it illustrates or it opens the door for further downside. Well, guess what? We did get further downside. How much further downside is the market capable of? Well, we could take the entire Trump rally away. And what I'm defining as the Trump rally is simply this. Let's take a look. And for that, I have to go back in time. All right, so we're back in time now, and let's take a look. This is the October election, and that's when everything sparked to the upside. Here we currently are right now. We are against an old shelf of resistance, and this is a pretty strong support shelf. It also puts us back into this time zone area. Now, when you take a look at the longer term picture and the advanced decline, you go, well, I don't know if I want to sell against this level here right yet, especially now that I see a potential convergence pattern in the McClellan oscillator. But if the market were to, at least with the NYSE, the New York Stock Exchange Composite Index, and remember, we're not trading NYSE, we're trading S&Ps, we're trading Qs, we're trading Dow component stocks. What is based on the NYSE? Well, it's interest rate sensitive stocks for the most part. 65% of the weight of this index is interest rate sensitive stocks. Interest rates have gone up. The Fed's going to meet. They're going to raise rates possibly a quarter point in Wednesday, December 19th meeting. Excuse me for that. But the question begs, can the market go to zero? And I don't know if these readings suggest we're going to go to zero right away. We kind of fell off the beaten path here, so to speak. The market did not, in the NYSE, did not rally and make newer highs this year. There was that slight divergence situation between the other stock indices, meaning the S&Ps rallied to new highs, the Dow made a new high, the Qs made a new high, NYSE didn't. So now that we're here, what are we going to do about it, right? Is this a time to be selling against maybe old highs and support? The market's come back and tested that level. I would suggest that this is not Fed-induced sell-off. This is a more political situation, and let me explain what I mean. If we have gridlock, it's not good for the market in the terms that no more new fiscal policy or legislation may be enacted. There will be gridlock, and that in this case might not be good, or that's what the market sees at this point. So it's kind of like throw everything out the window first, shoot first, ask questions later, and that's the market environment we see. But I don't think that we have a lot of sectors in the market right now that are just absolutely going to crash. Where market may be getting a slight bit ahead of itself. And even if we are to see a longer term prolonged bear market, in time we see markets that do what? Make rally and then consolidate for a period of time before moving down. Even if we go back in history, and I want to do that with you right now so that you get a better grasp of things. If we were going to go down, if you take a look at what happened in 2007, which we are in a completely different environment than 2007 and 8, the market definitely had consecutive periods of what? Consolidation before we even saw downdrafts. So we were seeing what? A longer term prolonged market condition that made subsequent lower highs and lower lows over time. And the advanced decline, if we go back through history and look at that, right? It never went straight down. There were bumps along the way. So it is my contention, looking through history, while granted the advanced decline indicators, breadth of the market as it's referred to, is not healthy. It's not as bad right now as maybe many seem to think. So the market is capable of a potential dead cat bounce or subsequent rally back up to its moving averages. And we call that, in technical world, we call that regression to the means. And I'm going to bring this into focus so that you can see what are we referring to. The moving average, and this is a simple moving average over here. The moving average is there, price is here, and we've departed a little too far from the mean. So therefore, we're probably due for some kind of recovery in time. Now, we just broke below a support shelf, Now we're going to see if the market goes back up and tests that shelf of support and sees maybe some interest in buying. What's keeping the market from rallying? Confidence. And what is the confidence? Forward guidance, as well as what? Leadership, and how can corporations price in their cost of doing business when we're uncertain about A, interest rates, and B, fiscal policy or legislation coming out of the government. That's what this market's about right now. So I'm not looking to sell everything in a portfolio. I'm recommending to our clients to be more weighted towards cash, and the market will be seeing these subsequent sharp rallies, which was what bear markets make them difficult to trade, because people look to buy breakouts and then it jams right back down. They sell breakdowns and it jams right back up. So I'm suggesting right now, with the McClellan oscillator as a guide, things are not as bad. And again, with where the position of price is against history, it is not as bad as what maybe you think. And the market is vulnerable still for Santa Claus to show up on Wall Street. Thanks for watching, and I hope this information helped you at least navigate what we need to look for. And again, if the market is to rally, then we want to make sure that we see, at the very least, the sell signals cover those positions. Right now, systems are still short, and we see that a 60-minute close over the first hour bar high is where those stops or trailing stops would be in place. So if the market is to rally, the shorts have to cover first, and then we'll see if the systems generate longs for a small upside move. Thanks for watching.